Have you ever stopped to think about what money really is? It's more than coins, bills, or numbers on a screen. It's a driving force behind economies, an invisible influence that shapes societies, and a powerful tool that determines opportunities in our lives. In this video, we're going to dive deep into the heart of money, what it is, how it works, why it has value, and what roles it plays in our day-to-day lives. We'll explore everything from its origins to its impact on individuals and entire nations. By understanding the anatomy of money, you'll gain insight into the forces that impact every aspect of your life, and maybe even how to master them. Money, it's something we use daily, but have you ever questioned what really gives it value? At its core, money is a medium of exchange. Thousands of years ago, our ancestors bartered goods, trading sheep for grain or tools for clothing. This system had a huge problem: matching needs. Enter money, a universally accepted item that makes transactions seamless. We'll explore the evolution of money, from cowrie shells and precious metals to paper currency and today's digital tokens. Money has certain characteristics that make it effective. First, durability. Money must withstand physical wear and tear. Coins and paper bills last a long time, while digital money is virtually indestructible. Second, divisibility. Money must be easily divided into smaller units to facilitate all sizes of transactions. Third, portability. Money should be easy to carry and transfer. Fourth, uniformity. All units must be the same, so people can easily determine their value. Fifth, acceptability. Everyone must recognize and accept money in exchange for goods and services. Finally, stability. Money should hold its value over time, allowing people to plan for the future. We can't understand money today without examining where it came from. Imagine living in a world without money, trading chickens for shoes or rice for fabric. The barter system was inefficient because it required a double coincidence of wants. Both parties had to want what the other offered. This inefficiency led to the development of commodity money, such as gold and silver, which held intrinsic value because they were scarce and desirable. As societies grew, carrying large amounts of metal became cumbersome, leading to the rise of paper money. Originally, paper notes were backed by gold or silver reserves, giving people confidence in their value. Eventually, the gold standard was abandoned, and we transitioned to fiat money, currency that has value because the government says it does. Today, money is mostly digital, existing as numbers in bank accounts and on credit cards. Fast forward to the 21st century, and we see the emergence of digital currencies like Bitcoin. Cryptocurrencies are decentralized, meaning they are not controlled by any government or central authority. They use blockchain technology, which ensures transparency and security. Bitcoin and other cryptocurrencies challenge our traditional notions of money and represent the latest evolution in the history of money, offering new possibilities and raising new questions about the future of finance. We need to uncover how money actually works, the role of banks, the concept of fiat money, and how central banks create and regulate money. Fiat money has no intrinsic value. It's valuable because we believe in it, and because the government guarantees its value. Banks play a crucial role in the money system. When you deposit money in a bank, it doesn't just sit there. Banks use a system called fractional reserve banking, where they keep a fraction of deposits in reserve and lend out the rest. This process effectively creates new money as borrowers receive loans that they then spend, which gets redeposited and lent out again. This money multiplication increases the money supply, which can stimulate economic growth but also carries risks if too much money is created. Central banks, like the Federal Reserve in the United States, manage the money supply and interest rates to keep the economy stable. They use tools like open market operations, reserve requirements, and the discount rate to influence how much money is circulating. Inflation and deflation are key concerns. Too much money leads to inflation, reducing purchasing power, while too little can lead to deflation and economic stagnation. Central banks aim to strike a balance to maintain stable growth. Money doesn't operate in a vacuum. It's intricately tied to the economy. The flow of money is like the circulatory system of an economy. It keeps everything moving and growing. Gross domestic product, GDP, is a key measure of economic activity. It represents the total value of goods and services produced in a country. When people spend money, businesses grow and GDP increases. Interest rates set by central banks influence how much people borrow and spend. Low interest rates make borrowing cheap, encouraging spending and investment, while high rates have the opposite effect. An increase in the money supply can lead to economic growth, but if it grows too quickly, it can cause inflation. Fiscal policy, which involves government spending and taxation, and monetary policy, which involves managing the money supply and interest rates, are tools used by governments to influence the economy. Understanding these policies helps us see the bigger picture of how money influences our world. Money isn't just about numbers, it's deeply psychological. Why do we save for some things and impulsively spend on others? We'll explore concepts like delayed gratification, the ability to resist the temptation for an immediate reward in favor of a later, often larger reward. People who practice delayed gratification tend to save more and make better financial decisions. Risk tolerance is another important factor. How comfortable are you with uncertainty? Some people are natural risk takers, while others are risk averse. This affects how we invest, save, and spend. Behavioral economics shows us that humans are not always rational with money. We have cognitive biases, such as the tendency to follow the crowd, herd behavior, or to place too much importance on recent events, recency bias. Understanding these psychological principles can help you recognize your own behaviors and make more informed financial decisions. Cryptocurrency is a game changer in the world of money. Blockchain, the technology behind Bitcoin, offers transparency, security, and decentralization. Unlike traditional currencies, which are controlled by central banks, cryptocurrencies are decentralized, meaning no single entity has control. This decentralization is seen as a major advantage, as it reduces the risk of manipulation by governments or financial institutions. We'll break down how cryptocurrencies work. Transactions are recorded on a public ledger called a blockchain, which is maintained by a network of computers, nodes. Each transaction is verified by miners who use computational power to solve complex mathematical problems. This process ensures that transactions are secure and that the same coin cannot be spent twice. Stablecoins, which are cryptocurrencies pegged to stable assets like the US dollar, providing the benefits of digital currency without the extreme volatility. Central bank digital currencies, CBDCs, are another important development. These are digital versions of traditional currencies, issued and regulated by central banks. They offer the convenience of digital transactions while maintaining government control. The digital revolution is reshaping the future of money, but it also comes with challenges, including regulatory concerns, environmental impact due to energy consumption, and the need for broader adoption and trust. Money is not just an economic tool, it's also a social force. It shapes power dynamics, creates opportunities, and unfortunately, also widens inequalities. Wealth distribution is heavily skewed, with a small percentage of the population holding the majority of the wealth. This concentration of wealth leads to disparities in access to education, healthcare, and opportunities. We'll explore how government policies affect wealth inequality. For instance, tax policies can either reduce or exacerbate inequality, depending on how they're structured. Social programs funded by taxes can provide support for those in need, helping to level the playing field. However, the wealth gap continues to grow due to factors like unequal access to quality education, differences in inheritance, and the increasing returns on capital versus labor. Money can be a tool for empowerment. Those with financial resources have the power to influence politics, support causes, and create change. However, it can also be a source of division, perpetuating cycles of poverty and limiting social mobility. Understanding the role of money in society helps us see both its potential for good and the challenges it presents in creating a fairer world. Money has a dark side. Wherever there is money, crime often follows. Corruption, bribery, and money laundering are just a few examples of how people misuse money for personal gain. Financial fraud, such as Ponzi schemes, exploits people's trust and often leads to devastating losses for those involved. The 2008 financial crisis, for example, was triggered by the collapse of the housing bubble and risky lending practices. It led to widespread unemployment, foreclosures, and a loss of trust in financial institutions. The lessons learned from past crises, such as the importance of regulation, transparency, and responsible lending, to prevent future collapses, are very valuable. Let's bring this conversation closer to home. How can you master your own money? This session will cover the basics of personal finance, budgeting, saving, investing, and managing debt. A budget is a plan for your money, helping you track income and expenses so you can make informed decisions. 50-30-20 rule is allocating 50% of your income to needs, 30% to wants, and 20% to savings and debt repayment. Saving is crucial for financial security. We need to build an emergency fund, enough to cover 3 to 6 months of expenses to protect yourself against unexpected events like job loss or medical emergencies. Investing is the key to growing your wealth over time. There are different types of investments, such as stocks, bonds, and real estate, and the diversification is important to manage risk. Managing debt is also an important aspect of personal finance. Not all debt is bad. Some, like a mortgage, can help you build wealth, while high-interest debt, like credit cards, can be detrimental. There are strategies for paying off debt, such as the snowball and avalanche methods. Finally, we'll discuss the power of compounding, how reinvesting your earnings can lead to exponential growth over time. Mastering money isn't about earning more, it's about making smart choices with what you have. In our final chapter, we'll explore the philosophical questions about money. What is the true purpose of wealth? Can money buy happiness? We'll discuss different viewpoints, from the minimalist movement that advocates for less is more, to the idea that wealth can be a powerful tool for doing good. Minimalists believe that reducing our attachment to material possessions can lead to greater happiness and fulfillment. On the other hand, wealth can provide freedom, security, and the ability to make a positive impact on the world. We'll also explore the concept of financial independence, the idea that money can buy you freedom from the need to work, allowing you to spend your time on things that truly matter to you. Money is a means to an end, not the end itself. Understanding your own relationship with money can help you align your financial decisions with your values and goals, ultimately leading to a more fulfilling life. Money is complex. It's a tool, a force, a necessity, and sometimes even a source of stress. But by understanding its anatomy, we can demystify it and take control of our financial destinies. Remember, money should serve you, not the other way around. If you found this video insightful, make sure to like, subscribe, and share it with others who want to understand the world of money better. Knowledge is power, and the more we understand money, the better we can use it to build the lives we want. Thank you for watching, and until next time, stay informed and stay empowered.